very much, everyone. Thank you for your time. We know it's a bit of a specific QuantMinds session with all of the travel restrictions, so thank you very much for those that made it on site today. So I'm Sylvain, I'm co-founder of CEO of SESAMm, a company specializing in natural language processing for finance. I'm joined today by Badr Ghazlane, one of our project managers, who will tell you a bit more about some of the quantitative use cases that we have with regards to ESG data. So the context of this session is that as an AI company working in the field of quantitative analysis, we've been exposed in the past few years to a number of requests related to ESG data, both by fundamental teams and by quant teams. And our perspective is that ESG data is mostly a data topic, and which in most cases should be to some extent controlled by the quant side of the firm. And what we observe in the industry is that it's actually usually not the case, due to the way ESG data is currently structured. ESG data tends to be very low frequency. It tends to be data that is hard to really quantify per se, and that is relatively complex to include in portfolio optimization, trading strategies, and the like. So what we wanted to show you today is some examples of how innovative technologies, in particular natural language processing, so text analysis, can be leveraged in order to kind of give back power to quants with regards to ESG data, and to complement some of the traditional indicators and ratings that are provided by ESG communities, the likes of MSCI ratings, Sustainalytics, and the like, which you likely have been exposed to already. So that's really the context of this presentation, using NLP in order to power quant strategies and quant decision using ESG. And the way we'll structure the presentation is I'm going to start with just a brief introduction, especially on the technology and tools that we use, so that you have some context of the types of platforms, types of content that we leverage in order to generate signals and alerts. And then Badr is going to dive in more detail into actual signals that we generate and how they can be used in the context of either alerting for both quant and fundamental teams or actual systematic strategy. So that should really be the plan. So my part is going to be a bit higher level, just focusing on the technologies overall, etc. And I'm going to give you a 2-minute presentation of the company, just so that you know what we do. And then we're going to dive into the real interesting stuff with Badr later on. Okay, so just a word about the company very briefly. We're a team of 70 people. A company that was created in 2014 that specializes in alternative data with a focus on natural language processing and machine learning in finance. So basically what we do is we extract billions of news contents, blog posts, social media messages, and the like from the web, and we translate them into analytics. So I think it's likely that 100% of you have heard about sentiment analysis in finance. We do that, and we do ESG topics classification based on these web contents that are extracted. The advantage of leveraging web contents in ESG is that this is basically the work that analysts are doing. So they are looking at the latest publishment from an NGO website or from a financial news website and the like, and manually annotating that data in order for it to correspond to an ESG framework. And we can do that same work automatically or almost automatically. So that's NLP, how we see it and how we leverage that in finance. Just for context, most of our team is based in France, and we have offices around the globe, including in New York, London, and Tokyo. All right, so some example of clients, names that you may be familiar with, and a ton of hedge funds which we can't name. All right, so just a bit of context on the platform and technology, and how we think it's possible to generate relevant ESG signals with textual contents, with news contents, blog posts, websites, and the like. So the context first is that at SESAMm we have a huge amount of text information that is stored in our data lake. We have around 16 billion articles and messages coming from a variety of sources. So ESG has this specificity that not everything is contained in financial news content. So there's a lot of ESG information that may be missed by the traditional Bloomberg or Reuters feed, especially when it's related to social and governance issues that may emerge from, for example, from employee comments or from whistleblower alerts generated on social media. So we find it interesting from the perspective of generating ESG content to take a look at something that is broader than just traditional financial news data, and to go into blog posts, social media, and things that are a bit more alternative. So a typical example of that, and why we believe that web contents in general can be useful, is Some of the major money laundering or tax evasion controversies have first emerged on Reddit in the past few years, prior to being mentioned in traditional news media. And in the same thing, whistleblower alerts and employee issues have mostly emerged on these social platforms. So we're specifically looking for that content that is a bit harder to find than traditional news websites. So we have 16 billion articles and messages, that enormous data lake, 4 million sources, and a variety of different contents, and the necessary historical data to be able to backtest that information and really get actionable time series and signals that can be incorporated in strategies. So that's the first technology brick, if you wish, getting access and structuring that data in a way that is machine readable. And we do that at SESAMm by both partnering with data firms and data aggregators and news websites and the like, and also by doing some of the extraction ourselves through data scraping. So once we have that first brick, and again, this is not meant to be just a sales pitch. This is also, if you want to generate your own analytics, first thing that you're going to need is a lot of data subscription or the ability to scrape data by yourself in order to structure that data lake. And having access to the historical data is one of the pains if you're doing purely data scraping, because it's going to be very hard to go back in time. So once you have that first part, the second part is starting to generate relevant information from these contents. And there are two tasks that are usually quite important. One is very important in order to separate noise from information, and that's the whole part of name entity recognition, ticker mapping, etc., finding information that is related to the securities that are of interest to you. When you only focus on news contents, say you have a Bloomberg article or Reuters article, it tends to be relatively easy, because these types of contents are already mapped by default, and the company names are not very ambiguous because the size of the universe is relatively small. When you go into smaller companies and alternative websites beyond traditional news data, it can become very, very difficult. And especially consider the task of differentiating Apple the fruit, Apple the company, that may be simple and can be solved in most cases by name entity recognition algorithms. When you're going into smaller companies and especially SMEs on the equity side, most NER system will actually fail at identifying these entities, and you need to be a bit more creative. So that can be, for example, training your own name entity recognition algorithm, or doing a combination of row text matching and NER, or in some cases, using other technologies like embeddings or language models to compute similarity. I'll dive into this in a bit more detail later, and if you have any questions on the terms, etc., and are less familiar, let me know. So you need to find the company names, their subsidiaries, their CEOs, etc., inside the contents, and you need to map these together. So we have what is called a knowledge graph, which maps all of the entities together, needs to be point in time, and needs to also reference not only the ultimate parent company, but all of the subsidiaries and all of the C-level executives. So that is the second thing that you're going to need if you want to generate ESG insights, is a knowledge graph in order to not just identify the security reference, but really identify the company name, the main shareholders, CEOs, etc., etc. And once you have that, once you know that a specific article or message is relevant in your context, you can then apply a set of algorithms to detect relevant either ESG keywords, ESG context in more generally, through classification, for example, and also usually allocate a polarity to that to know whether the content is rather positive, so say positive impact, sustainable development goals and the like, or rather negative with regards to ESG risk. We do a bit of both, but we usually focus more on ESG risk when looking at systematic ESG data. So what we track is actually controversies. We want to understand when something is going wrong, and we want to really be the first one to know, including based on really alternative sources, including social media. And finally, once we have that information, so the initial raw data, the ability to map it to security through named entity recognition, similarity, etc., and finally, the ability to identify specific topics and perform sentiment analysis, usually through supervised or unsupervised machine learning tasks, then we really have that ability to generate relevant ESG contents. So just an illustration, I was mentioning before that named entity recognition will fail in a lot of cases to identify small companies, whether these are small listed SMEs or private companies. Actually, there are more and more quantitative use cases on private companies. So the way we're going to address the mapping of the company is going to be through a combination of NER and also computing similarities between the representations of the article and the representation of the company's description. So here you see you have an example of an article on a company, rather on the positive side, BHP calls times on coal. And then you have a description of the company on the right. Both are vectorized using embeddings, and then we compute the similarity. And this complements traditional name entity recognition and tells us, okay, it's likely that this context actually corresponds to the company that you're looking for and not to BHP as an acronym that may be related to something else. And that same methodology can also be applied to matching ESG contexts, because you really have two options. Either you do supervised learning, you rely on a team of analysts to manually map ESG context, define category classes, and then train an algorithm to reproduce that decision. This works well, but it's not very flexible. And in the context of moving regulations, new ESG categories, EU taxonomy, SFDR, etc., we sometimes want to have more flexible approaches. So again, computing similarity and defining, for example, a set of ESG keywords or ESG sentences in natural language, and then computing the similarity to the corresponding article can help you really find a relevant context without having to, with less manual annotation and less work by analysts. So this is one of the techniques that we use in order to go beyond what's possible with supervised learning and with annotating each ESG category manually. We also use a lot of similarity analysis, which also enables clients to build their own ESG context. They input their own keywords, their own descriptions, and can have a new ESG context created. So that's some of the technology that is used. So again, just to illustrate some of the building blocks and some of the things that you may need, here, this part using embeddings and language model is a choice. So some ESG teams or some quant teams that are doing topic classification will rather use supervised learning, but this is really a choice and both work quite well. All right, so just an illustration of how it looks like. We compute environmental, social, governance scores. We compute different categories. And from a quant perspective, what we're most interested in is it usually translates to a daily time series, which we can use like market data, meaning that we're going to compute that similarity to a specific governance topic over time and weighted by negative sentiment so as to be sure that we focus on controversies. And ultimately, the output is going to look to some extent like market data. So it's going to be an open high, low close time series, and we're going to be able to inject that in models. Another thing that we can do is use that data in order to generate alerts based on specific thresholds or specific behaviors and trade on these alerts directly whenever there is something abnormal that is happening on that data. So these will be controversies alerts, and that is what Badr will be illustrating. So yeah, I'm just going to pass that, but this basically means that we can have either systematic streams of data like that, so data that can be just consumed algorithmically, injected in models, used for optimization and the like. We call that streams at SESAMm. And for example, we have an ESG data stream with data from 28, around 90 risk categories that are being tracked, mapped to individual securities, FIGI, IZIN, etc. So consumable like market data. And the other option is that teams also build their own ESG factors, because again, moving regulation, everyone has its own hypothesis and criteria with regards to how they want to leverage ESG. And so a lot of teams want actually to have kind of a research environment where they can test hypotheses and build their own ESG time series rather than just standardize ESG time series. The holy grail is just to be able to really define all of your factors by yourself and not to be reliant on the methodology that is imposed by a third-party provider. And that's what we try to do when we provide our modular API. All right, that was just for context, and then we do custom projects, and here I'm going to transition to Badr so that he can tell you a bit more about what it actually leads to, and from a quantitative perspective, the kind of results that we can obtain with these technologies.
Okay, perfect. Thanks, Sylvain. Hi, everyone. So as Sylvain explained, we have approximately 30 minutes to discuss about ESG controversies. So as he mentioned, we know that ethical investment is getting more important. And the reason is pretty obvious. More and more investment firms are tracking and monitoring the ESG activities of companies on their portfolio. And so that's why we're talking about the ESG controversies. So in few words, Sylvain explained what is ESG, and a controversy is just a negative event raised by a company. And so the goal here is to understand and to track the ESG controversies of the companies. And so to do so, there are different types of ESG scores that are used. And I'm pretty sure that you know the type of reputation score that most of the companies provide. And those one are low latency. It means that you need a lot of information to shift those scores. And so they are very stable. And so the goal here is to focus more on scores that are more reactive, because sometimes there are some small news that have some huge impact. And so the goal is really to have a controversy score that is more reactive than reputation score. And that's why we detailed that today. And also this score, even if they are more reactive, we can provide that in time series and use them as alpha signals in machine learning models. So the presentation is pretty interesting because we will see how the ESG analyst will use these signals to monitor and track the ESG controversies, but also how the machine learning models can use these signals in order to build some alpha generation strategies. And so to do so, the first part of this deep dive is to focus on what is the controversy score. Then we'll just look at the workflow to understand how it is built and how this score is used by ESG analysts and in quant models. And then we'll have one use case that we had approximately 2 weeks ago that is very interesting and that showcase how useful is this controversy score. And then we'll look at some financial strategies to look at the performance. This will help to understand how we can generate alpha with this type of signals. And also feel free to interrupt if you want to ask questions. Interactive presentation are always better than just a speech. Okay, so right here we describe what is the controversy score. So as I said, it's important to understand that we're talking about a risk score and not a reputation score. So the scale is to 0 to 5 and it's integers. It's a daily score. We compute that every day. And we have 3 components, so basically 3 time series, E, S, and G. And we can also provide sub-risk. So in E, S, and G, we have subtopics, and we can also provide more than 3 time series. Then on the algorithm, it's a decision tree. So I will explain in a few minutes why this choice is quite important. And this decision tree is based on the sentiment of the articles. So Sylvain explained that we have algorithms that compute sentiment in text reveal, but also on ESG volumes. And that's pretty important because the goal of this decision tree is to understand if an event or news is capturing all the attention of the media. And so this helps to understand how important a news is relative to all the articles mentioning the company. So we use many other features, but those 2 are pretty important. And so we have a last part of the algorithm that helps to detect the same controversy, because when we have one controversy day 1, most of the time when it's very important, it's broadcasted by other media, and so it's good for the analyst to have the information aggregated. And so we have algorithms that aggregate the controversies across the week to make sure that we don't spam the ESG analyst with the same information over time. And then on the advantages, The first point is quite interesting because we're robust to low volume companies. It means that the algorithm is not biased by the size and the volume of articles that a company will have. And so if you have a company that have on average 10 articles per year, we're able to find the controversy the same way as a company that will generate, for example, 10,000 articles per year. And so it opens to the world of private equity because there are so many companies with a low volume articles that we are able to track correctly with this controversy score. And of course, this decision tree was fine-tuned not only automatically, but based on the ESG experts. So we annotate so many events, so many controversies, and it leads to fine-tuning manually the decision tree. And so we know that the ESG expertise is used on that decision tree. And I was saying that the choice of the algorithm was important. The reason is that most of the risk score are biased by the volume, but when you take the, for example, just these two variables and you build the decision tree, you can make sure that the output, so 0, 1, 2, 3, 4, 5, are not biased by the volume, as you will use these variables in the split nodes and not just as a factor, for example. So that's a small summary of the controversy score. Any question on that before moving on to the workflow? Okay, clear. In this chart, I'll explain quickly the workflow of this controversy score. So Sylvain explained what we have in the data lake. So we have more than 16 billion articles. So from that data lake, the goal is to fetch all the articles that mention the company. But when I say mention the company, it's not just the name of the company. We use the knowledge graph to get all the documents that mention the CEO, the products. And so we have all the articles that can impact the company. And so we find that, and then we check with the ambiguation algorithm that the articles are really mentioning the company. And then we compute the sentiment using CNN models. And then once we have all the articles with sentiment that mention the company, we use the ESG knowledge base. And that's quite important because it contains a kind of complete taxonomy with ESG topics. And this taxonomy and knowledge base is being improved over time with the ESG expert feedback. And so we have trends that are added because there are some new type of controversies that we have with time. And we also have the ESG team that improve this ESG knowledge base. And so it helps to detect all the articles that are mentioning a controversy in the article, and then we compute our controversy score. The controversy score, when it's bigger than 3, generate an alert, and the alert is sent to the client. So on that part here, it's more ESG analyst, but what we do at the same time is that we store all these daily alerts in historical data, and this historical data can be used for a quant approach. And right here you can see that this score is always being annotated, and so it's being improved, and if we detect some new trends, then the decision tree is improved and updated to make sure that we can always consider a new type of controversies. So now let's look at the performance of this score. So first thing to say, right here we're looking at the precision of this controversy score, and on this bar chart we can see the precision of the score for 3/5 grades, 4/5, and 5/5. This was computed on a universe of 500 companies from 2018 to 2021. And what we can see is that for very severe alerts, we have 100% precision. It means that when the controversy score is raising a 5/5 score, 100% of the time, this is a controversy. So that's a very good point. And then you can see that for the others, it's 97% and then 74%. So I'm pretty sure that your question is, what about the recall? So this one is more complex to estimate because it's pretty subjective. It depends on the knowledge of ESG analysts of the controversies of companies. And so what we know, given the ESG feedback, is that there's no major controversies that were missed. And so we'll see that on the example, but thanks to the size of the data lake, we're able to find some really small controversies, and that's why the recall is pretty good, even if I don't have the real estimation of it. And on the second part, we can see the volume of controversies. So you can see that the minor controversies represent a huge part of the controversies, but we have 747 very severe controversies, and on average, we have 2.4 alerts per year per company, and so that corresponds to what investment companies want. If it's too big, then you spam the ESG analyst, and if you miss alerts, then the controversy score is useless. Any questions so far? Okay. So now we'll just look at one use case before to deep dive on the performance. So that's a use case of 2 weeks ago, and we'll focus on XFAB company. It's a Belgian company, world-leading semiconductor producer, and they're based on different countries, so France, US, Malaysia, and Germany, and they have approximately 3,000 employees. And we raised one controversy on the 23rd of November, and the controversy is a governance controversy. And what happened is that mid-November, there was an accident in a warehouse in the Texas, US, and one employee was injured and another one was killed. And so in our data lake, we have one blog article about the accident on mid-November, but it didn't raise an alert. But then on the 22nd of November, we detected 3 articles, and the 3 articles are mentioning a lawsuit because the family of the employee that was killed sues XFAB company. And so you can see that that's the type of email that we send to the client. The email is sent automatically. You can see that we put the name of the company, the type of risk, the negative sentiment of the article. As you can see, it really depends on the type of document. So there's a small variance on the negative score, but we still have the same virality score for all the articles. And so this was sent before the market opens. You'll see that's important. So right here, we can see the impact on the price. And so different to notice on that plot. Right here, we can see the timeline and when our data lake fetch the news. And then we can see the stock price. So we had the first information of the lawsuit on the 22nd at 5 p.m. And we can see that from that moment to 2 days after, so from that moment to the close of of the 24th, the price impact is 8.64%. And so at this moment, we're able to detect the controversy. And so if we look at the price impact from the open of the 23rd, then the price impact is 6.4%. So you can see that with the email we sent and with the time series we sent to the client, they're able to have the information of a severe controversy before the market opens. And then there are some questions maybe about the market impact, because you can see right here that at the open of the 23rd, there's a huge volume of selling positions. So yeah, if we want to give more detail, the market impact here is quite important. So if there's no question, I'll move on to the strategy part. So what we did is that we used the universe that I mentioned, so 400 companies, so the 400 largest French stocks over 3 years, and we built a simple strategy. So the goal is not to short the controversies. The goal is to show that most of the controversies leads to a negative return and that we're able to detect that. And to do so, we show that strategy. So we short controversial stocks for 5 days when we have the signals. And to make sure that we're not biased by the market, then we have a delta hedge portfolio with the CAC 40 future. And the results are interesting. We can see that on all the controversies, and we have a lot, so 5,000 corresponds to the number of days in position on all the companies, so on the 400 largest stocks. And we have the P&L per turnover is 17 bips. And we can see that the most interesting category is the social one, where we have 29 bips per turnover. And if we look at the chart, here it is. In blue, you have all the controversies. And then on purple, you can see environment. As you saw, I think, on the previous slide, we don't have a lot of controversies on environment. One of the reasons is a sector bias, because not all the companies are able to trigger severe controversies on the environment, whereas all the companies are able to trigger social and governance controversies. So that's a part that explains that we have less positions on the environmental sector. And so, yeah, let's forget the environment for now and let's focus on governance and social. We can see that those two sectors are very interesting from an alpha point of view. And we can see, as I said before, that for the social we have 29 bips per turnover. And
maybe because it's a French university, so social controversies are at the forefront.
Yeah, also. Yes. And also one of the points is that it's difficult to short small stocks, and that's why what we provide in the other slide is the same analysis, but on a smaller scope. So the scope here is the 60 largest French stocks. So it's the 400 companies intersection with the MSCI World Index to make sure that we can short these stocks. And what we can see is that for social, we still have 17 bips per turnover. So yeah, the conclusion here is that social controversies is still profitable on large stocks, and we still have issues to have signal on environment, but maybe on another sector, another universe, we can have more signals on environment, and that's something that we'll deep dive and we're looking at SESAMm. And so yeah, here is the chart. Okay, so before giving the floor to Sylvain, just want to make sure that there's no question on this deep dive. Okay, perfect. Sylvain, the floor is yours.
Thanks. And just wanted to give a conclusion to that research that we performed, which is in no way meant to be a off-the-shelf tradable strategy, but just food for thought with regards to leveraging NLP in ESG. So the first thing that we see is that it is possible with NLP to actually get actionable daily time series and alerts which behave or look like market data and which can actually be incorporated in models. So that's actually something that is by itself interesting in the sense that traditional ESG data tends to be quite lagged, not so timely, updated a few times per year, etc., and tends to have a behavior that is not ideal in order to be used in portfolio optimizations or investment signals. I think the other side of this coin is that in order to get there, it's necessary to have really a very large amount of data. We have a huge data lake, and our coverage, including of smaller companies like we saw on the 400 French stocks, is linked to access also to sources beyond traditional news content. So in order to get that very relatively high frequency data in terms of ESG factors, it's also necessary to really have a huge amount of information. And why I'm saying that is that when you look at sentiment data, e-reputation, etc., you're going to have a lot of positive contents, even on small companies, through press releases and the like. But when you're looking at controversies, by itself, you're going to have fewer contents, so you need an even wider source of data. So we see that that type of algorithm can help obtain timely ESG data that is very systematic, that has fewer biases potentially than analyst work, where the methodology is very, very quantitative, and where coverage can be better. What I'm mentioning also coverage, SMEs is a natural problem in ESG. So MSCI covers 8,500 companies out of a total universe of listed companies that is around 40,000. So you see there's a lot of coverage that is actually missing in traditional ESG scores. But also on our side, and maybe in your jobs, you see a lot of private equity use cases coming up, with a lot of quantitative work being done on private companies. And this is also something that is not well addressed at this point in ESG, and where it's literally impossible with manual work to cover all private companies worldwide. It's literally millions of companies. So I think as we see more quant work being done in private equity, there's going to be also more need for this type of technology to quantify ESG factors without pure human intervention. So we've seen some of the results of the scores. To give you some context, this score is actually shared with some of our clients, including one ESG rating agency that has a team of analysts and the like. So this is really signals that are used in day-to-day in order to rate companies. And we're pretty happy with the results and the accuracy. And it also gives us a view on the average number of controversies that are actually relevant and being generated, 2.4 per year. And this contrasts a bit with the once per year average rating updates that is done by ESG agencies on companies. So again, it points out that there is certainly some inefficiency to profit from. And the underlying what's interesting also for a lot of our clients is that there appears to be more and more of an ESG momentum as adoption of traditional ESG ratings is becoming really mainstream, meaning that capitals tend to shift at the time that ESG ratings are updated. And one use case that we're actually exploring with that type of data, not just predicting price or going directly for alpha generation, but is also looking at predicting rating changes, actually. So looking at what analysts could actually do in the future based on just information being obtained more quickly. So kind of that momentum that is being built in the market and that is starting to appear, and that we could profit from with this kind of higher frequency data. So yeah, we saw the backtesting, obviously very naive strategies and just for research purposes, but really positive results, especially on the social side as we saw, and with quite representative behaviors. And we're currently expanding this to a larger universe So currently on a systematic basis, we cover around 15,000 companies, but we have a knowledge graph of 3 million companies, so we're continuing to expand and to really try to benefit as much as possible from that systematic approach from a coverage perspective. So yeah, I hope this encourages you to do NLP, to try things out with regards to ESG data, and also to maybe go for that kind of higher frequency ESG data that is becoming available in the market, either by working with providers like us or by doing work by yourself. It's also possible. And we'd love to talk about this. And if you're doing some NLP in-house, we'd love to exchange ideas, see what you guys are doing, and talk a bit about this ESG controversy topics that is becoming very important for quant use cases. Thank you very much, and very happy to receive your questions. Yes?
You are shorting controversies, no? But have you checked your volumes, your shorting volumes against other market shorting volumes? So you entering the market, do you anticipate what the market does?
I'm not sure to hear the question. I don't know if you can use the microphone, please.
No, I was asking, you are shorting controversies, right?
Yeah.
You're entering the market with your short orders. Have you been looking at the volumes of your orders against what the market does? If you anticipate other agents operating in the same market?
So you mean the market impact of the short position?
Yeah, because you get like the signal at 10. You get the signal at 10 a.m. and then let's say the market also operates. So
yeah, so it's here.
Compare you entering the market against other agents, not in terms of return, in terms of volumes,
Yeah.
other agents entering the market.
Yeah, that was one of my points here. If you see, the information is available at 5 p.m. On the 22nd of November. And then the huge selling position are at the open of the 23rd. And so you can see that most of the people have the information on the 23rd. And so we don't know exactly what are the sources that they used, but the one we used was available on the 22nd.
Sorry, to be clear, we didn't do a full market impact analysis or anything like that. This is just research purpose. So there's certainly hypotheses to refine, etc., with regards to this, especially as some of these are small stocks. So, yeah.
And do you know why you missed the information about the worker being killed? Was that in your database, or is that just a document that you weren't, you didn't have kind of upstream?
I haven't heard the first part, sorry.
Do you understand why you missed the information about the worker being killed in the first instance before the lawsuit? Was that information that you had available, or was that something you were missing? And
yeah, that's a good point. And so we had one article on the data lake. We had one article on the data lake that says that there's one accident in the Texas warehouse. But this article was not a controversy, because a controversy linked to governance is a lawsuit. And once the lawsuit was not, so as the family hasn't sued yet the company, then there's no governance controversy yet. But we had the information of the accident in the database.
Just didn't raise the alert yet, basically.
Yeah.
That raises the question, though, why as a quick follow-up on this, so it raises the question, why is an accident not classified as a controversy to start with, or is that something that your experts have then picked up to reclassify and adjust?
Yeah, so what we know is that there are some investment companies that use some regulation in order to know if a controversy is severe or average. And so from this regulation, the investment companies sometimes has to sell the position of the company or to keep it. And so depending on the type of controversy, sometimes they have to sell. And when they sell, there's an impact on the price. So it depends on the type of controversies.
It's basically to really create an exclusion mechanism and we want to benefit from that momentum. So we want to see potentially people excluding the stock from their portfolio due to a change or rating or etc. And to tackle an exclusion, you have to have the lawsuit. Actually, if you have an accident in a factory, you won't be at the level where the company may be reclassified as not compatible with an ESG portfolio under Article 8 or Article 9, for example. So that's why we try to keep that close also to existing taxonomies from a regulatory perspective to try and benefit from these momentum effects when a stock gets excluded, basically. And that is relatively systematic because when it gets excluded, then it gets excluded from all portfolios at the same time. So these are the events that we're interested in. But it depends also on what we are looking for. In the end, it's just a list of keywords, sentences, etc., and fine-tuning. So it also depends on what we are searching for. There's a question there. Thanks.
Two things. One is in one of your earlier slides, you were talking about delta hedging. If I understand you correctly, I think you meant your beta hedging the portfolio, like eliminating the exposure of the names to the market, so just looking at the excess alpha. Is that correct? My understanding correct?
Yes, the reason as we delta hedge the portfolio is to make sure that the returns that we compute are not biased by the market. Okay. And so we take a long position on the index and then we short the stocks in the index. But it's just to keep some realistic results, otherwise we would show the performance of the market and not of our signal.
Okay, the second thing is in your testing with out-of-sample data, have you noticed any meaningful alpha decay?
Yeah, so there are some different studies that we conducted on this topic, and for example, there are some insights on the duration of the short position depending on the events, and we have some results on this. Yeah, that's the type of analysis that we did too, not just like performance analysis.
Maybe to add to that on alpha decay. Alpha decay is a very big topic in sentiment analysis. So we have that discussion a lot with hedge funds. One thing that we have is, as we don't focus just on news data, the variety of sources limits the alpha decay to some extent compared to if you're using like Refinitiv data, Dow Jones DNA, very specific data set that a lot of people are trading on, then the alpha decay is a bit more critical. With the variety of sources that we have, the process is a bit harder to reproduce, and so alpha decay tends to be more mitigated. But you're right, it's always a topic in alternative data, is trying to prevent that alpha decay and getting signals that are more or less exclusive as much as possible, which is why we have the modular API, people building their own signals without disclosing that with everyone else. So that's another part, yeah.
Great presentation, thank you very much.
Thank you.
Yeah, hey, thank you for the presentation. I'm just curious on one thing. Is it working? Yeah.
Yeah, it works.
Did you notice any maybe low risk controversy raised after to go back to the XFAB case, after the first scenario of the killings? Because you guys said that you have a whole scale of risk score for all your controversies.
Yeah.
So I'm just curious about that.
So your question is if we have a low score that evolves in severe score, right?
Yeah, I mean, related to what you were just saying, they could have been maybe a low risk score after the killing, then which became a very high risk score, like the 5 out of 5 after the suing, right?
Yeah, so the one article that we detected, was it already a small controversy, like 1, 2, 3?
Yeah, it was a small controversy.
But not 4 or 5, but the small one. Okay.
Yeah, it's a small one, and then it doesn't trigger an alert. But as you can see here, we have a lot of controversies that are minor, So if you look at 0/5 and 1/5, there are approximately 100,000 controversies. And in these controversies, we can find some small events. So it's a big event, but it's considered a small event, someone who has an accident on the workplace.
And you have to consider that there's a team of analysts in the background from one of our clients using that. So not spamming is actually pretty important as a topic. So yeah, that's the reason. All right. Thank you very much for your time.